Hi, welcome to Dog and Pony. I'm Vince Thompson. With the markets gyrating wildly and the future uncertain, it's an interesting time for startups. Imagine launching a financial startup right now. Well, Dan Ripoll, co-founder of Aeon Capital, and his partner are doing just that with a hedge fund that has the goal of helping their clients successfully manage risk. Tell us about the experience you and your partner had and how you decided to start a hedge fund.
My partner and I actually met years ago, back in 1996, on the equity and derivative trading desks at Merrill Lynch. Back in 2003, we went on a research initiative designed to improve the scalability and risk management features of our trading strategies. After a few years, we developed something that was scalable and that was capable of becoming a fund. And so we launched the fund in February of last year, and here we are today.
Can you start by telling us a little bit more about what a hedge fund is and how it works?
The difference between a hedge fund and a traditional investment like an index fund or a mutual fund is that hedge funds have more latitude to manage risk for clients. So what that means is that in an environment like this, hedge funds can use derivatives or futures or reduce their holdings in equities in order to protect clients from the downside of a market such as the one we're in now.
This really comes down to trust. People are turning their money over to you.
Right.
How do you build trust with people?
We build trust, I think, by explaining and trying to be very clear about what it is that we do. A lot of people in the general public think of investing as rocket science, and it's really not. And so what we try to do is bring it home and put the things that we do in concrete terms that people can understand. And when people feel that they can understand your process, I think they're more likely to trust you and invest with you.
Market risk, it's on everybody's mind, right? What advice do you have for people in turbulent markets?
Don't try to pick the bottom. I've been in this game a long time, and that's the mistake that I see people make over and over again. 95% of the public, if you were to show a stock chart, let's say, to an individual, and let's say you showed two stock charts. One, you showed a stock going up, let's say Apple Computer from $10 to $50, I think, earlier in the decade, and a stock that went from $50 to $10. Well, the majority of the investment public would say that they're more interested in buying the stock that went from 50 to 10. What we're saying, and what our empirical research has proven, is that the stock that's going up is likely to continue going up. An object in motion is likely to stay in motion. That exists in the market too. And so we focus on opportunities where things are performing because the likelihood is that in the future those same things will continue to perform. And what we do is we focus on limiting the losses on the ventures where we're wrong.
We're talking today in late '08. You haven't lost any money for your investors this year.
Right.
Almost all of us have lost money. Talk to us about that.
There are two main reasons for that. One is diversification. The second is risk management. So let's start with diversification. The best antidote for an efficient portfolio is broad diversification. If you think of the fund as an airplane, then diversification across assets, especially assets that aren't correlated to one another, can be thought of as the airplane's wingspan. The longer the wingspan, the more stable the ride. And so what we do is we include assets that are not correlated to stocks, such as currencies and commodities, and we trade those both long and short. On the risk management side, say you were to take a quarter, and every time the quarter landed on heads, you would earn 25 cents. When it lands on tails, you were to lose 25 cents. Say you had a risk management process where you only lost 10 cents on the ventures where you landed on tails. But you didn't do anything to cap your upside on the ventures where you flipped heads. And so over 1,000 flips of the coin now that you've limited your downside, you would have a $75 profit. That's all our process does, is limit the downside on the ventures where we're wrong. And we do nothing to cap our upside in the ventures where we're right. And so over time, that expectancy is realized over a large sample of trades.
How do you think the market's going to change, the financial industry is going to change as a result of what we're going through?
I think people are going to begin to question traditional wisdom. Armies of brokers and analysts preach a certain methodology which is based on buying and holding through periods of time, long periods of time. And what we're saying is that there's a more efficient way to put your money to work, or at least ways to protect your capital so that you don't suffer these types of declines. And we've discovered ways to do that, and that's what we do. We aim to make more money over time by losing less in times like these.
Dan Ripoll, co-founder of Aeon Capital. Thank you very much.
Thanks for having me.
Yeah, it's been great having you on Dog and Pony. As always, if you have questions or comments or just want to stick around and read our blog, go to dogandpony.com. I'm Vince Thompson. Thanks so much for watching.